It's funny, he just texted me, Brittany, about, hey, what about 5%, 6%, 7%, 8% down? It's like, Brittany tries to protect my time, which is, I appreciate. She's like, his system doesn't always do that. But it's something where we can show those offers and show those differences, saying, hey, it's not that really big of a deal if you do have to bump up another, $5,000 or whatnot. It's the difference of you going to, not going to Qdoba twice in a month, right? So, really running those numbers, because it's not that big of a difference when it really comes down to it. So with hers, we had to pivot, and this is one of the first times that we had really done this in a while. I kind of call it Jesse Bop's down payment assistance program, through a lender credit, right? So if they, depending where their income limit is, and unfortunately the income limits haven't changed for a conventional down payment assistance offer, and I feel like in like 2 or 3 years, it's still right around, the mid 80,000s. And if you wake over that, then you can still go Metro DPA, but now you're paying a bunch of MI. So now your coverage is at 35% on that MI coverage, which, unless you have really good credit, can kind of sting, right? So, so what we did with hers, we pivoted and said, okay, if we went down payment assistance with you, your interest rate is going to be 5.25%. And here's how much money you're going to have. And then that's not going to be it'll be forgivable after 36 payments. Or we can do, I can give you a 5% interest rate. I think we actually locked her at like 4.99. I can give you 4.99, do a lender credit. You don't have to mess with any of those, the DPA type deal. If we need a DPA to offset the appraisal gap, then we can go back to it. But once the appraisal comes in, we can pivot and go to the lender credit option, to where, I think her appraisal came in 1,000 over on a little condo. So we didn't have to go DPA. She doesn't have to wait 3 years to either sell it or repay that back, as far as that, that second, that silent second goes. And we were able to, for one, give her a better interest rate than the down payment assistance. She's free and clear. That money, I think it was like a $500 difference. So she had to bring another $500 to the closing, but her rate's way better. She doesn't have to wait to refinance that. And we were able to close it in, like, I think we closed that condo in 13 days. One reason why we're also able to close that condo is getting your buyers actually pre-approved, right? So you have 3 types of approvals. So this is, good information if you have any listings and you're looking at, you're looking at offers. If they have a pre-qual, like pre-qual is, that's garbage. That means they talked to somebody, American Financing or Guaranteed Rate. They said, hey, here's my stated income, here's my stated assets, and here's where I think my FICO is that I haven't, checked in 5 years. So that's, that's not very strong. Pre-approval, you're gonna have all your documents. We pull credit. We're going to verify assets. We're gonna run in our AUS system to where we're actually gonna get an approved eligible findings, and that's a solid pre-approval. So when you're, looking at that, you wanna make sure that, are they actually through AUS? And when you start using that terminology with lenders, they're like, okay, I can't pull one over on this person. They know what is going on. And the AUS is just the automatic underwriting system that we use. And most lenders are going to use to underwrite that once it kind of gets to it. So when you get a pre-approval from Fairway, typically, or from me, it's going to be an actual pre-approval. I don't do pre-quals. That's a lot of guessing work and a lot of stress on the backside. Buyers already give us enough, grief by, quitting jobs and doing silly things with credit and money. We don't need to add any stress onto our already stressful jobs, right? So, so what we did with her to make it easier as well is we went through an actual TBD pre-approval. So we disclosed it just like we would if we were under contract. So she signed all of her disclosures, and everything on the address just says TBD. So we go through underwriting, they underwrite it, they give us an approval, and then that way I can shoot over with your lender letter for your pre-approval an actual underwriting approval and saying, hey, now we are as good as and as fast as cash, right? So now we can close this literally once we get title work, we get HOA docs if we need them, in an appraisal, right? So in that way, you're not saying, oh, well, cash deal can close in 9 to 10 days. And I was like, all right, well, so can we, right? So, so we were able to get her into that condo because we were able to close in like 13 days. And that was just because they needed to finish a couple things. But it was also, I also knew that agent on that deal as well. So when you're putting offers in, make sure that you're reaching out to your lender and saying, hey, can you call us agent? that really helps. I feel like when I can call an agent and kind of sell the buyer, we have way better chances of getting that accepted, just because, you know, it doesn't matter if it's nighttime, weekends, takes 5 seconds to make a call. And I actually like doing it because then it builds a relationship with that person saying, hey, you know, available, here's my phone number, you know, let us know how we can help you.
Jesse, you like doing it because
So,
you make a new agent partner.
Well, you're not supposed to tell anybody that. Sure, that's backside.
Right.
That's definitely back burner.
Right.
First thing is trying to get the people under contract and then impress that person too.
Right.
You know, to get them to work with you, right? So,
right.
Yeah, cold calling is no fun. So just, you know, you get your job during the you know, transaction. That's how you build your business.
You ask for a coffee every time too.
So
right. Well, so I think what Jesse.
I'm not a coffee guy.
No. Yeah, me neither.
Not a coffee meeting.
No.
But
you know, I think you know the biggest thing that Jesse's touching on though is the pre-approval. You know, making sure that we actually have them prepared. You know, if you can compete, and one of the biggest advantages is that quick close. You know, being prepared and having Jesse having that underwriting completed, or the lender having that underwriting completed. You know, you can put in those tight close deadlines and be competitive with the cash offer. So I think that's a big one to remember, just to be competitive.
Yeah, absolutely. When I'm talking to a lot of listing agents, you know, I try to get as much information as I can to report it back to you guys, you know, to try to make our offer a little bit stronger if we do need to go up, or, you know, if they don't need a quick close, they might need a free rent back. So any information I can get, I usually try to pass on to you guys so you guys can, you know, spin however you guys want it, right? Because a lot of people are like, oh, we can close fast. Well, we need to buy a house too, so we actually want a 30-day close and a 60-day rent back. So, you know, don't sell a fast close if that's not what they need, right? So I'd probably say, you know, a lot of questions aren't asked when people are throwing offers in, but just ask them what they need, right? So, and getting them to understand it isn't always the easiest thing either. So, you know, we have a dad that called me yesterday on a deal, and he was asking about the rent back and why we do a rent back, and, you know, and I was like, well, that's just the market we're in. So you're not gonna. He's like, I thought they would pay rent. I was like, no. If you didn't want to get that condo, then you can charge them rent, but then you're not getting that condo.
Right.
You know, so I'd say, you know, also with your offers, I'm seeing a lot of people either, you know, making their earnest money go hard after inspection, or, you know, just right away, which that is kind of a little bit scary for people. You know, essentially that's like a new build situation. Doubling your earnest money, I think, is something I've seen. I've recommended, you know, people doing, from like, hey, you're not giving up inspection, you're not giving up the appraisal deadline or anything like that. But if you can double your earnest money, then that way it shows that you're serious. And then that way, you know, the listing agent's like, oh, you're doubling, you know, going from 5 to 10, you know, they're a little bit more serious about their offer. So I've seen a couple agents do that, and that's been pretty impactful. You know, in terms of programs and stuff like that, Jared and I have a large or a jumbo program that is purchased that's closing on Friday. Initially, they were going in, you know, at 1.1 and change. We did have an appraisal come in about 110 grand short, which wasn't awesome. But the program that I had them set up in had that, you know, wiggle room to where essentially they didn't need to bring any more money to closing. And it took me about 30 minutes for them to really let that sink in, because they see the appraisal like, oh my God, you know, I have to bring another 110 grand to closing. I was like, no, the program we have you set up is just going to change your loan to value. So you essentially don't need to bring an extra dime to closing. It just might change your interest rate just a little bit because your loan to value is off. So they were like, after it sunk in, they called me back and they were just like, so we're not bringing any more money? I was like, no. And so that was huge, because in that way, you know, they're getting ready to sell another house. If they want to put more money on the next house, you know, with a you know, what's called a recast, that's something you can do as well. And, you know, we can go over that at a later time, but you know, it's kind of like a second down payment once you're already in servicing. So if somebody's going to sell a house like they're going to after the fact, say if they put 20% down now, in a couple of months after they make a payment or two, they can actually do the recast, put another chunk down to reset their payment to where they want it to be. And that's not a crazy, you know, expensive thing to do. It's usually a filing fee and redoing the deed and the note and all that kind of stuff, because they'll be different. But it does take a couple months to do that, but it does help buyers kind of get their monthly payment back down to where they want it to be. Usually it's a minimum of like, you know, 15 to 20 grand, you know, that they have to put down. but unless they're putting a huge chunk down, it's not really worth it. So they might do a recast from the one on Friday, but yeah, it was super smooth transaction. And that helped us get under contract as well, because I told the agent, she's like, well, do they have funds verified? And I was like, well, they have funds verified, but as a safety net, we can go down to 10% on this, jumbo program that we're underwriting, that's in-house. And so if they don't want to bring in extra money, it's built in. And she's like, oh, sweet. So that like really kind of helped her, saying, okay, they have, worst case, they're already covered and they don't have to bring any more money. Because that's usually the biggest thing, where people start panicking, like, oh, I'm going to liquidate everything and, get HELOCs. And that's where panic mode sets in. And that's where, listing agents don't like the, a lot of what ifs. It's like, here's plan A and here's plan B, so she was stoked.
But and let me just kind of recap what, the client that Jesse's chatting about. The reason we got the offer accepted is we put in a full appraisal coverage. And I think this is why you got to have a creative lender, and you got to have somebody that's willing to put in the work, because we ended up putting in the full appraisal coverage, and then the appraisal came in 110,000 low. Having that 110,000 low and having Jesse able to actually, articulate and sell to the client why they don't have to bring the additional 110. No additional money came out of their pocket. And there was a few changes within that interest rate, but they were still able to get the house with no additional funds. So I think, being crafty and creative, putting in those full appraisal coverages, see where that appraisal comes in. Did we want the 110,000 low? No. Did I think it was going to be 110,000 low? Yes. So I was anticipating it, but I think it was, we kept the deal together. And I think it was just because they didn't have to come up with, they would have had to come up with what, $350,000 almost just to keep it together. And instead they didn't. They kept their original down payment, the money they already knew they had, and nothing changed really for them. And it didn't really change their payment much, did it?
No. Essentially, I think their payment went up maybe $55, just because they decided not to, keep the same interest rate. Because when you are the more you put down, the better your interest rate is going to be, right? So from 5 to 10 to 15 to 20, and then your best interest rate is going to be 25% down or more. It doesn't matter if it's the second home, primary investment. The 25% threshold is going to be your best case for interest rates. For them, also the really cool thing with the jumbo programs, most jumbo programs don't have MI, right? So usually that's your threshold for a conventional loan, to where you're saying, hey, if I put less down, now I have MI, right? So, but for this jumbo program that we have, there's no MI, right? These programs are set up for people to have, really good credit, reserves if needed, good down payment funds, but these people have 800 credit, to where, and they are required to bring 0 reserves to the table, right? So that's a big thing for jumbo as well. So depending on how many reserves they have, but, it changed their payment, under $100. I think it might have been $50 or $60, but there's no MI change if the loan to value does change, which that's huge. Because if it was conventional, then yeah, now they're paying MI and, getting rid of that, eventually when appraisal gap comes in. So, and there's even options we can look at that, versus putting a lot more money down. If they want to save more money, we can do a single MI, option, or, do something like that. So I usually don't recommend doing single MI in higher rate situations like we're in right now, because in 6 months, if the interest rate drops, it might not make sense for them to actually refinance the month to month unless you're going to stay there for a super long time.
Right. I think the other part too that was helpful is you were also able to help them with buy down, weren't you? Some buy down points, some buy down options.
Correct. So I use Mortgage Coach a lot, and it's kind of a really quick snapshot of the ins and outs. Depending which lender you work with, they're not getting paid off interest rate. So for us, it's trying to get them the best rate possible, but I have a threshold to keep at certain levels for what the rate actually costs, right? So the worst thing mortgages does is they'll say, oh, rates are at 4.25 today. Well, that's also with 740 credit score and really good income, debt to income, down payment, that kind of stuff. So that's like best case scenario, but that's like the cost of the mortgage rate. So it's like you see something online, it's like, oh, it's $75. Well, those shoes don't cost $75. There's a cost of doing that business, right? So when people are like, oh, I saw rates at 3.25 or whatever it is, that was 6 months ago. But so when you're educating these people, then that way it really helps when you can educate them what it actually is, right? So I said, hey, because they wanted to kind of keep their payment, as low as possible on the 30-year, but then these are the type of people like, hey, what about a 15-year? What about a 20-year? Because they're just going to keep putting a lot of money on that payment anyways. So I gave them an option of like, here's 3.875, here's 4%, and here's 4 and an 8, just to show them the difference, because they're going to put more money on top anyway. So when I showed them if they're going to put that extra $1,900 every payment onto the loan, it turns their 30-year mortgage into a 20. And then, the difference at 10 years was less than $5,000. So for them to buy down, at that rate to keep it at the 3.75 doesn't really make sense for them. Just keep that cash. And then if they're just going to keep plowing money into it, then interest savings is really what you need to look at. And doing like a short-term and a long-term analysis for people, with refis or something like that, it's buying the rate down doesn't always make sense. Like, I was on the phone with one of Brittany's dad's clients yesterday, and he was going over all the buy down stuff and asked me a bunch of questions. And I literally said, hey, here's your break-even point for the 4 options. And it took me 5 minutes. And he was like, awesome. And they ended up not buying down because it doesn't make sense. Right. So even, even a $2,000 buy down on a $400,000 house is going to take you almost 5 years to make up. So cash is king. They're like, well, what if we put that money on your down payment? Once again, the whole $1,000, loan amount, if you take 1,000 off or add 1,000, it's $5 difference, right? So them adding 1% down payment is going to save them $15 a month. Young kid has to buy a house, has to buy, furniture and, moving expenses. I told them they should have just kept it, where it was in the minimum, but they want to put 6% down. So, but just giving them options, that's going to be a big thing for your client, so they don't feel like they're, in the dark. So
there you go. And I think this is why I think I wanted everybody to be on was really, having a lender that you trust. A lot of the stuff that Jesse's saying, sharing, and is able to present our clients is stuff that's completely out of my wheelhouse. It's stuff that I couldn't explain to them. I couldn't tell you the incentives or benefits from going one route or the other. And like he had said, my clients want to do 15-year loan. Well, that's just not an option. Well, what if we buy down? Well, you could buy down. Well, why don't you not buy down and just put the additional money, cash into your payment, paying additional principal each month? That additional principal is better option for them than the buy down. And it also gives them the flexibility of freedom if they don't want to pay that additional principal. If they want to keep their payment low, maybe they have a tough month, tough couple months, they don't have to, or they're not forced to have that increased payment. So, I think it's just looking at all of the options and not just thinking there's one route or one strategy, but knowing that each client that you have, that there's multiple routes, multiple strategies. It's good stuff. Who's got a buyer scenario? Somebody's got somebody out there. Sarah, who do you got?
I have, are you talking about the buyer accepted?
Well, that's one of them. I guess, do you have anybody else that you've got that's kind of in a difficult scenario or a tough situation?
Well, for sure, obviously first time home buyers, it's that being capped at 300 and seeing properties at, 275 or even a little bit less is just so hard right now. And let alone, just to compete, but then ask them to compete on every single level. And I think it's taking me or them maybe, or just me too, like explaining to them what, it's really going to take. And I just think I have a lot of people right now too, who just aren't in it enough to want to be creative or find a way. Like they're not that motivated, I guess, where I think in this market, you have to really want to buy a house. Otherwise you're not going to.
Right. You're not going to.
Yeah. So, no, I think it's helpful to keep exploring different options, and with obviously different scenarios too, but I don't know. And it's just you can't
I think Sarah, you touched on a very particular part though, and that's actually having the dedication from your clients, and I think if we describe the actual magnitude of the market, and I mean, there's so many benefits to buying. Appreciation alone is worth buying. I mean, if there's anybody who's bought a house in the last couple of years, they're sitting on tens of thousands, if not 100,000, a couple 100,000 in equity. And I think that, if that's not enough of a motivating factor for anybody, I don't know what is. We all have to have a roof over our head. We all have to, have a home. Why not make money doing it? So I think, if you can't get somebody on board, it is okay just to say, hey, maybe this isn't the option for you. It not only saves you the time and the headache, the effort, the energy, the gas in your car, and the wear and tear, but it also lets them kind of, take a little gauge on how they're feeling about it. If renting's, I say this, Matt Portolano, I wish he was on right now. I told him this. I said, hey, if renting's a better option for your family, then you go ahead and do it, dude. If you don't want to take advantage of appreciation, rent. I encourage you to. Guess what Matt did? He went and bought.
Yeah.
Yeah. Who else? Anybody else got an interesting scenario?
Does anybody have any issues with credit approval and getting people's credit up and stuff like that?
I think that's a good one. Is you're talking about the credit program that you can do?
Yeah, so we have a free credit repair program, but we also have a manual underwrite, which is technically they call it a jumbo product, but it is a manual underwrite written product where sometimes if somebody has a lower credit score, it doesn't matter what it is. So I have a buy right now, it doesn't matter what we do. She has 690 credit, putting 10% down, and it will just not run conventional. So we're having to flip her to a manual underwritten product with 10% down, but it goes all the way down to 600 FICO, to where the only difference between a manual underwrite and an automatic system, an AUS underwrite, is there's just a couple different extra boxes that they're checking. If it's reserves, late payments, anything like that. So, it's a little bit more in depth as far as an underwrite goes, but we do have, that program that the minimum loan amount is $100,000, but then the maximum loan amount is $2 million. So sometimes you have somebody that makes a boatload of money, but they missed the payment or they got divorced, and we all know what that does to people's credit sometimes, because I'm not paying the bill, you pay that bill, that kind of stuff. So there's a bunch of different programs for people with high credit scores and low credit scores. So a lot of times if people are afraid to pull it, you just have to get them into a lender that will work on their credit now, because like a broken heart, sometimes the only thing that's going to fix your credit is time. That's it, right? So the sooner they can do it, the better. We do it for free. There's no obligation. I'm sure I've fixed people's credit and then they've ghosted me and they went somewhere else to, get a loan from their cousin or something, which, hey, it's totally fine. It's the greater good. It's, just helping people, not with just, their mortgage needs, but it also helps you buying a car, credit cards, anything, right? So why not take that, free, free service and run with it, right? So sometimes I can fix people's credit in 2 weeks. Sometimes it takes 2 years. So we just closed a loan in December. I worked with a lady for 2 years on her credit. So, but hey, it was an extra pipeline. It was a $500,000 purchase, and it was like, oh, shit, you do have qualifying credit score now. Let's do it. So just keeping those extra little people in your pipeline. I know it's a pain, but keeping those extra people in your pipeline adds up, eventually.
Well, and I think if we just thought about it, if we don't help, if we've got one buyer and they are financing and we don't help them, we have to replace it with another one. So I think instead of giving up and not making it an option, I think working with a lender that you trust and working with somebody that finds creative solutions, routes, and remedies is where you could actually help and provide the service for anybody. So I think that we aren't privy to a lot of the systems and the tools, or really the financing routes that Jesse has available to him. But if you don't have a lender that has those routes and remedies, then it makes it real tough. It makes it daunting. There's not just one route for anybody.
Yeah, I'm pretty good at getting people motivated and, getting them excited about purchasing, right? So, like Jared said, buying a house for 250 and then, selling it for 500, 3 years later or 2 years later, or whatnot. So, or teaching them how to turn that property into an investment property. I think that excites most millennials because they want that, residual income. They want to be, a landlord or something like that. So I'm like, hey, here's the path. You can use down payment assistance to eventually turn that into, right? So it becomes kind of a teaching and training type deal to where, I get a lot of first-time home buyers actually excited, building them, getting them ready to purchase because the option of, future income, rentals, that kind of stuff. So, just, getting them excited to do, something that's next. It's not just what the purchase is. Also, when you're talking to your clients, sometimes they get really stressed out about down payments, or they get, stressed out about that, that payment. And, a thing I've been saying a lot lately is like, hey, this isn't your forever payments and it's not your forever home, right? So if you can get into the market and you can, justify that payment and make it work. And my biggest thing with first-time home buyers is making sure that they're comfortable with their payment. Because a lot of times, even if you can qualify for a $100,000, loan, doesn't mean you want to pay $3,000 a month, right? So first we look at their payment, see if that's realistic. I'll bring them down to earth. If they're like, hey, I want my monthly payment to be $1,000. Well, get a time warp machine, go back to 1980. That's not going to work. But I'll tell them like, hey, here's how payment actually breaks down. So you're not writing offers for people that are not prepared at all mentally for when it actually goes into a payment, right? Like I have a buddy in California that just sent me his pre-approval for $1.4 million. I was like, all right, cool. What's your interest rate? No, I didn't know. I don't know. He didn't give it to me. I was like, well, you're an adjustable rate arm, so you might want to check that. And he's like, yeah. I was like, ask questions, right? He could be writing offers on, $1.8 million homes, and then all of a sudden he finds out his payment's $5,000. You might be like second guessing that, right? So he's either gonna have to come up with more money, or he's gonna have to, reevaluate his budget, right? So a lot of times when we're writing offers for people, I like them reaching out to me saying, hey, what's the breakdown for this payment? So that way they can be super confident when they're writing that offer, to where it's not like, someone shaking while they're, writing that acceptance offer, when you guys are, getting that offer ready, right? So they know what they're getting themselves into. I used to be like, hey, send me all the properties, and before we do it, we'll run you numbers. I'm like, man, that's a little bit too much work at the moment. So give me the 3 you like, and we'll run numbers on those, right? So, but then that way they know which ones they're really going to land on. But getting them excited about homeownership is really big, and but you don't want to also be driving people around that aren't serious at all. Time is money for you guys, and once we get them under contract, it's our job to get you guys paid and get them to the closing table. But you don't want to be wasting your time driving people around that aren't credit qualified, that have no cash with a pre-qual. You're on mute, but.
That's one of the big things though, is working with people that are willing to put in the work to put themselves in a position to actually buy. I think sometimes when I was new and I was a new agent, I thought just because I was out shopping with people, I was doing my job, and I wasn't. I wasn't getting people under contract, and I wasn't getting to the closing table, but that's because I wasn't prepared, and neither were they. I think it's great that Jesse actually helps motivate and kind of get them encouraged to want to go through the process, want to get the house, identify the benefits to them. And if we're doing the same thing and beating that same drum, it makes it encouraging and positive for them. And if they're prepared, it makes it easier for us too. This isn't the market that we want to go drive around every weekend, shopping, but no idea actually how to. Jesse's helping me with a client right now, Nadia, who wanted me to go show her properties this last weekend. Well, we have no approval. I'm not going to run around all town until we actually have the approval. Let's work with Jesse. And Jesse's been doing great over the last week trying to pull this together for them, but it takes them doing the homework. It takes them being prepared. It takes them putting themselves in a position. I can help motivate, Jesse can help motivate and educate, but really at the bottom end of the day, it takes them doing the work. So I think it's great. I love the help that Jesse gives. I hope that everybody has the lender that does just exactly that for them. Any questions for Jesse?
Yeah, that's a good point, Jared. So like, real fast on those buyers for Nadia, like at a glance, they looked pretty strong on paper with their current job, but then they just started their job within the last 3 months. And then they had unemployment, and then they, so we're having to go past 2 years just to get their work history and their income figured out, to where, you had a guaranteed rate, or somebody that's just going to shoot it out. You're out there shopping, all of a sudden, you get to, approval, and it's falling apart. So it's, just really setting people up to fail.
Well, and not only setting people up to fail, it's setting us up to waste our time and setting them up to fail. So, I mean, we're really not even doing our job, or doing, participating in our responsibility. So I think it's imperative that we are prepared. It's not the market that it used to be. We used to be able to get homes under contract with just the pre-qual. Just a pre-qualification to get you home, not anymore. And I think we have to be prepared. And not only that, if we're doing things like the appraisal coverage, what does that look like? What are the actual, what are the ramifications of us having to bring that money to close, and are there other solutions? So I think with Jesse, helping me with the clients, us being 110,000 under value, but still not changing their payment much and not changing their down payment, it allowed us to keep it together and get it to the closing table.
And then, one more point as far as with the appraisal gap in appraisals and stuff like that, we had one of Brittany's clients that she did a really awesome job of checking, recent, almost closed under contract sales, and saying, hey, when are you guys closing? So in that way, she calls me and says, hey, don't, schedule your appraisal until this day. And then that way we make sure that closed sale hits that, that appraisal. And it did get bumped, so we were a little worried that it wouldn't hit, but most appraisers, they're going to want to make their job easier as well. And now that my wife is an appraiser, I know all the work that the pre-work that they do to go into it. So if you can get, when you do have something that you are trying to justify, or if it's a big appraisal gap, getting in front of that appraiser early, because a lot of times appraisers are going to they're married to those comps, right? So they pick 5 or 6 comps. They're going to drive those comps, because we're still in a very archaic situation for appraisers, saying oh, you need to make sure that house that sold 2 weeks ago is still standing. Well, we have a title company, a lender, 2 agents, an inspector, and everybody that has confirmed that house is still standing, but then they still have to go out and drive those comps. So the worst thing they can do is have to go back out to drive those comps, because they didn't realize another one was right across the street, or one's coming soon, or whatnot, right? So trying to get in front of those appraisers, saying, hey, here's the comps I want you to look at. This one closes on this day, and make sure that your lender is, timing that appraisal right. We did have to pay for a rush fee for that appraisal, which is, $250, but it was able to get us, only $2,000 under the asking price. So where, and what is 30, 40K over list. So it was really, beneficial for us to really time that appraisal to exactly when we did. So good job, Britt.
Like borderline harassing other agents. Like, when are you closing? What's the sales price? That worked out.
Yeah,
my client's happy.
Yeah, absolutely.
I think big picture, what this is really all about is this just isn't just agent directed. This is really a partnership that you have with the rest of the team that's involved in the transaction. Your lender being a huge part of that, especially, when you need help educating, when you need help guiding, when you need help motivating, having a strong lender partner that not only understands where they're at, where they need to be, but where they can go, I think is imperative. So if you don't have that same relationship with a lender, I'd encourage you to talk to Jesse. Jesse, do you lend in Florida at all?
We have, there's 3 people in our office that do, and we're actually starting a branch down there pretty soon ourselves. So we'll have some peeps down there.
Definitely. I guess anybody got any questions for Jesse?
I've got a little bit of a little off, it's not off topic, but a little strange with regards to our contracts. So we've got this new loan terms deadline, and then we have the new loan availability deadline.
Oh, yeah.
And I've been throwing it around a little bit. And in my mind, you don't have a new loan terms basically until we're 3 days before you're going to close because of the trig. So I know that we know that with the problem that the board was trying to solve, but in my mind, they've kind of like made it worse because my new loans, they tried to do it in chronological order, right? So you've got your new loan terms based upon your pre-approval letter, so to speak. But the new loan terms aren't actually locked in until 3 days before TRID. So the new loan availability deadline, it clearly states that it can't be based on loan terms. So Jesse, what do you think with regard to this new loan terms versus new loan availability deadlines that are identified in the contracts? Am I right in that new loan terms aren't really set in stone until TRID 3 days before closing? Or is that going to be actually beforehand? Or are we locked and loaded 2 weeks before closing?
I want to jump in real quick on this, Thomas, because you're kind of hitting it on the head, and that's kind of exactly how I feel about it. And if you read the section with the new loan terms, it includes any conditions. Well, these are underwriting conditions.
Correct.
Right? These are underwriting conditions that pop up post appraisal and also pop up pre clear to close. So those conditions can change at any time up until you have that clear to close. I think what's imperative on our side as buyers agents is to make sure that we protect our client with at least putting that new loan terms deadline after the appraisal, if not the 3 days before closing. The question then becomes, will a listing agent accept that? So there's two sides of that fence. Will the listing agent accept those terms? And as a buyer's agent, definitely include those terms. Definitely push that to 3 days before closing if you can. But I think you could still get away with at least having those new loan terms post appraisal would be my suggestion. Appraisal or post appraisal, if not 3 days before.
Agreed. Also, in new loan terms for me, when I'm looking at that portion where that affects, our buyers and everybody the most, I feel like is condos, because, sometimes if a condo budget comes back and it's not correct, and all of a sudden now they thought you could put 5% down, now you're putting 10% down. That's essentially no new loan terms that they were, blind to because they didn't know the budget, or the HOA wasn't running, a very strong, business on their front. So, I see that mostly on condos, to where, we had one last week where, HOA was a little bit lazy. They sent us a budget and the budget was completely off for what they needed in reserves. They had enough in an account, but their 2022 budget was off, right? So, our condo desk came back and said, hey, they might have to put 10% down. And I was like, no, let me go check it. So essentially at that point, that'd have been new loan terms for her, and she could have gotten out of it at that point, because now the new loan terms is she had to put 10% down to buy a non-warrantable condo. But we were able to fix the budget. I worked with the HOA to say, hey, I need this to state, X, because they had 10 years worth of reserves in their account, but their budget was off. So then once we fixed their budget, we sent it back into condo desk and they approved it, and we were good to go. We didn't have to put 10% down, but essentially that would have, botched that deal for her. I honestly, Thomas, I honestly don't worry about those dates too much, I'll be honest, because I don't go into these things blind. So when people are freaking out about clear to close and that kind of stuff, I know it's going to close. And with loan terms and that kind of stuff, it is a little tricky with, appraisal gas and stuff like that. So essentially that could be a new loan terms as well, when it's like, all right, well, that's why we want to definitely have the appraisal, because if it comes in way short and also like, now you have to put, another, $20,000 down, whatever the appraisal gap is, that also would, considered be new loan terms, right? Because it might throw off their loan to value to where now they're having to change their MI. Now they might not qualify. And really big right now is, you might qualify for 400 now, but rates have jumped up so high that, unless you are looking at that, for when they are actually going to close in the appraisal, then that's where that, a little gray area is. But honestly, I don't worry about that too much, just because I know with our underwriting team and the way we do it, we had clear to close. Our final loan, approval was technically yesterday for our jumbo. I knew we were going to get it first thing this morning, which you got at 7 this morning. So, my team's freaking out about it, but I'm like, no, we're good. Right. So I know it's going to close. Right. So if anything were to ever happen, we usually would cover some of, earnest money or whatever it was. And this was $30,000 worth of earnest money. So kind of putting my neck out there saying, oh, we're good. You know, we're going to be totally fine. But yeah, I would say push it out as far as possible just to safeguard your buyer. But usually if we go into it, I'm not worried about those dates at all.
I guess this is just like a theoretical discussion. Well, it's practical, but it's a discussion I'm having basically with almost any broker that I speak with, as well as any mortgage lender that I'm communicating with for whatever purpose.
Yeah.
Because, like I said, I know a problem they were trying to solve, but I think they've made it actually worse.
Yeah.
Because, like you're saying, what does the listing agent think? So I have to talk to the listing agent and explain to them that, you know, as an attorney, I don't believe that, and we go through, you know, the terms aren't locked in until they're literally locked in. So, you know, okay.
Yeah.
And then also I just have a little bit from a lender standpoint. What if a condominium has a insurance litigation outstanding? I've got a client who's got a property that they're going to sell that has roof damage that was repaired. And then after the insurance company paid, the insurance company said that that the appraisal that was used in the mediation or arbitration was not done in good faith. The federal court filing was 2012. It got kicked back to the states to solve a state question, which then went through a judge retirement and has gone to the Supreme Court of Colorado. So they finally have solved the law question in 2022. So we're 10 years later. It's still got to go back to the federal court to go through the process. So it still has another bunch of years worth of litigation to go on.
Yeah.
So how does the lender see this, you know, outstanding litigation, so to speak? Because I've already had one buyer terminate. They were a cash buyer because, you know, they don't have to buy a litigation, but this litigation is just literally looming. It's been looming 10 years. It's going to loom another 3 to 4. So how does the underwriting see this, you know, pending litigation, so to speak? Is it radioactive, or is it you know, it is what it is?
It depends. You know, there's a bunch of layers of litigation, right? So if they're getting sued, if they're at liability, or if they're suing somebody, right? So that's the first thing my underwriting team will ask, like, all right, they're under litigation, what's it for? You know, a lot of times we'll see litigation for a landscaper that, you know, messed up something, and they're suing them for, you know, somebody falling and not doing ice melt and, you know, shoveling correctly, right? So it does depend what it is. The biggest thing that our underwriting team and most lenders are going to look at is what's the liability for the HOA, and do they have enough coverage? If they had to pay for something, do they have enough, you know, coverage to do that? For us, we've had a bunch of stuff go through litigation, you know, with HOA stuff. Typically, you would have to do a 10% down scenario to where you get a limited review. And the limited review isn't going to really dig, you know, too far deep into, you know, the financials and stuff like that. But you'll get a limited review if you're at least putting 10% down. But on your condo cert, once the lender gets that, they will, one of the questions on there is, are you under litigation? And then a lot of times, you know, there's, you know, we can't reach out to lawyers, and lawyers are going to give us very little on what it's about and that kind of stuff. But you know, I know that we do a lot of those things with, you know, kind of getting through the weeds and saying, hey, is the property secure, and is the asset, you know, still maintained? Do they have a budget, that kind of stuff? And we can get past that. So because we have an entire just condo desk that only deals with litigation, only deals with that kind of stuff. And we can kind of, you know, you and I can kind of chit chat. If whatever you have for that, I can literally present that to my team and say, hey, how would you guys view this, and what would we need to do? Yeah,
because I already spoke with the attorney who's been doing all of the appeals and the oral arguments and actual trial. You know, he's billing by the hour, so he'd be more than happy to tell you about the whole thing, right? I cut him off after about 10 minutes and was like, well, you know, this falls into you just can't make it up, right? Thank you so much for the information. Goodbye, click. And then, you know, I pulled up the actual opinions to figure out what the hell's going on. rather than
Yeah.
letting him do this dissertation on procedurals and
Yeah.
all. So
Yeah. Yeah.
I just want to know, as far as your underwriting is concerned, right? Just because they find
Yeah.
out
So,
that
so
there's
they're
litigation,
essentially suing.
have
So
the-
they're going after the insurance company.
No, the insurance company sued the HOA
The roof. Oh, okay. Okay.
because
Okay.
the appraiser was, not third part. They were third party independent, but they showed bias. So it literally is new law in Colorado that's going to end up going nationwide with regards to an insurance company is going to go to arbitration, and then the insurance company is going to say, well, your appraiser was biased. So let's bind all this up in court. So it's actually giving insurance companies way too much leverage, but
Yeah, absolutely.
yeah, it's new law. And bad law
Yeah,
comes
that
from
doesn't
bad
doesn't sound great. Yeah.
No.
Yeah.
So if anybody's looking in Dakota Station down in Littleton, it's I'll have more of an update later.
This is why it's
Yeah. Well,
imperative.
I would love to hear about it just so we can try to figure some stuff out. So.
This is why it's imperative to have a good lender partner.
Jesse's awesome.
I paid Janelle to say
I
that.
paid her to say that.
Hey, I said that.
So did I.
Saving some deals.
She popped in just to say that real fast.
Right.
There's been a district.
Recommend them. Don't use them.
Yeah, don't use them. Then it'll get busy.
Then he'll get too busy for me.
Well, this was good.
Just kidding.
This was good stuff, Jesse. Thanks for jumping on. I would definitely touch base
Got
with Jesse. Jesse, you want to throw your info in the little chat box real quick, just
Yep,
for everybody. If anybody has any thoughts or comments, questions for me, let me know. Kristen, thanks for jumping on today. I was going to tell you, shoot me an email or a text with all of the questions that you have. I know we covered an immense amount of stuff and threw out some verbiage that you probably aren't aware of, but definitely let me know what questions you have. Jesse's a great go-to as far as just at least have a second opinion or to pick his brain. Here's the scenario I've got. He's a guy that'll work through it with you, and not only that, he's the guy that'll stand up for you when you need it too. So definitely recommend you guys find a partner. And if you don't have one now, you got Jesse. So we appreciate it, man. Thank you.
Thank you.
Anybody?
Have a good day, guys.
Anything else, guys? No? There you go. Happy Wednesday. Thanks, guys.
Good luck.
Thanks.